All right, thank you, everybody. Thank you. All right, so I'm going to this is going to be a treat for everybody. I'm going to try to take the entire world of geopolitics and crypto and try to break it down into something that's simple enough for pretty much anybody to understand. It's a difficult task, but that's what I'm here to do. I'll start by saying we've been in this crypto space for a long time. If you look back to the way it was when crypto first came out, it was kind of all theoretical. How will the world respond to crypto? What will all these different countries do? It was not something that we fully understood. This last year, 2019, was the first year where we finally got it. I'm going to give you a little background on our firm. This firm is it's my brother and I and a few associates we have. We've been in the space from pretty early days. We were both kind of interested in monetary policy and kind of Austrian economics, those kinds of things, so we got into it pretty early, maybe like 2012, 2013, 2014, around that time. And have been in the space and had the opportunity to watch it grow since then. My brother is known for some of the Mt. Gox rehabilitation stuff early on, Daniel Kelman. I'm more known for, in 2014, I wrote a bill that was submitted to Congress called the 2014 Online Market Protection Act, which was designed to exempt crypto transactions that were kind of crypto to crypto from taxation and regulation and kind of keep it at the fiat to crypto level. Now, so what I'm going to do, what I've seen as we've gotten through this past year or two is we can now kind of identify a framework to look at how different countries are approaching crypto. I published a few articles a couple of weeks ago with Cointelegraph that kind of lay it out. Now, essentially, the way that this system works, the way the world system from a regulatory crypto perspective works, is that it's centered around the Bretton Woods system, the kind of current monetary system and how they react to the rise of crypto. And I'd say again, I mean, if you look back to the way it was at the beginning, all of these things were theoretical. We didn't know how these countries would react. We just sort of, and in the way that the press kind of covers this is still that these countries are kind of operating independent of each other outside of some system. But if you consider how they behaved in the past year, we've actually been able to see the kind of fissures of a system emerge. And the way that we define it is through these three groups. We've got the insiders, which are the countries that are kind of benefited from the current financial system stemming out of Bretton Woods. The outsiders, which are the ones outside of the system, the large economies from outside of the system. And then the experimenters, which are the countries which have kind of used the system to their advantage historically. And we've seen with the rise of crypto in the past several years, these countries have come up with their own regimes to kind of benefit themselves and look at ways of kind of acting between these two parts of the system to help the industry to bring in crypto projects and kind of support their own economies. So the first group are the insiders. It's pretty straightforward. The way that we look at the system is historical. How did the system come to be? Prior to the Second World War, U.S. foreign policy was designed to try to create a global free trade system. You had a mercantile world. You had a world dominated by European colonialism, where the European countries had their own kind of mercantile system. It cost money to get access to this system for these countries and their own colonial systems, and they kind of controlled those economies from Europe. The U.S. had long wanted to have a global free trade system. It wasn't able to accomplish this until after the Second World War with the Bretton Woods system, which created a whole global banking system around the dollar. The center of that system is New York. It's the New York Department of Financial Services, which grants dollar clearing access to 10 or 15 banks, all of which are European, Japanese, American, these kind of insider country banks. And that's to get access to that. If all the other banks in the world, all the other countries in the world pay for access to it. And in a nutshell, that's how the world financial system had worked prior to the rise of cryptocurrencies. And for the most part, that's how it still works. So how did they get Europeans on board with this? Well, after the Second World War, their economy was decimated, and they gave $1 trillion to the Europeans and Japanese to rebuild their economy, something to an organization called the OECD. This was called the Marshall Plan. And so from 1948 until 1960, a lot of these funds were spent rebuilding this, Europe and these places, but the OECD ended up with a lot of money. By the 1960s, they refocused on kind of global policy in general, and they formed something called FATF. Now, FATF is the organization that decides which countries are high risk and which countries are low risk. Now, you can look at it as subjective, you can look at it as objective. They would say it's a very objective standard. The high risk money laundering countries are the bad guys. The low risk money laundering countries are the good guys. It just so happens that it maps kind of perfectly onto their own countries that are members of this group. But that's up to kind of researchers to decide. My personal view is kind of a realpolitik view, where I think, for the most part, they must be behaving on some level of self-interest. I think you can look at the United States and Great Britain as certain countries that certainly have a lot of money laundering and are still considered very low risk. Some of the smaller jurisdictions are higher risk despite not having a lot of it. But anyway, sanctions also play a role in this. The other group we have are the outsider countries. These are countries which used to be a very small percentage of the world economy and are now close to a majority of it between the this kind of developing world countries, especially led by China. Now, one thing to note about the insiders, their interest when it comes to crypto, as we've seen in the past year or two, is that in the near term, crypto is good for them because they're receiving massive capital flows from these places and elsewhere. The money that's going to the ICO projects and everything else comes mostly to developed countries on the insider group. But in the long term, obviously, cryptocurrencies can be disruptive. You look at what they have control of the dollar. Stable coins are, I think, obviously a threat to the dollar in that sense. And I think we saw that with Libra last year. Now, for these countries, China, Russia, India, these developing nations, it's the opposite. In the long term, there's a disruptive, especially for countries like Russia and China that are kind of antagonistic to this global financial system. For them, in the long term, it might be good. It might disrupt that system and put them on a level playing field. They don't need to pay for access. They don't need to kind of get access through doing what, for political reasons what the insider countries want. They are on kind of a level playing field, and at this point, and going into the future, they're going to have more economic power, so they see it as a good thing for them. But in the near term, it is bad for them. They need to maintain their own currencies in a system that's governed by this dollar kind of global reserve currency. They need to get access to the dollar all the time. They have to pay for access to it. It's harder for them to get access to it in that sense. Only these few banks that are in New York under NYDFS that have dollar clearing have that access. The last group are the experimenter countries. You look at Switzerland as a good example. They've been playing this role of acting between these two sides as a somewhat insider country, but not part of the official group, kind of figuring out ways to bring in money from war-torn Europe in the 19th and 20th century. You now see Singapore is kind of playing a similar role. What we've seen with these countries is that they started off not really changing their laws so much, but they became the haven for a lot of early crypto projects. You look at Crypto Valley in Switzerland. More recently, we've seen Malta and Bermuda experiment with actual explicit laws around crypto. So if you look at the timeline and the history of crypto regulations, I would kind of look at the beginning as a Bretton Woods system I talked about in the 40s, where the whole world was around the dollar, but the dollar could be traded for gold up until 1971 when the US left the gold standard. Then from 71 until 2008, we were in this interim period. From 2008, we had Bitcoin, which didn't catch anyone's radar until 2014 with Mt. Gox. We saw the New York Department of Financial Services and the New York State government start to recognize this as a serious issue. So they passed the New York Bit license. A lot of it was overtly in response to Mt. Gox, which obviously we all know about. That was the big crypto exchange crash where a large percentage of all the crypto market crashed and that it was all on this exchange in Japan. And the reaction was to pass a kind of onerous banking license called the Bit license, very similar to banking license, although because crypto companies offer less services, wasn't quite as broad, but also contained this kind of cybersecurity component. But at that time, the focus was the monetary threat of Bitcoin, the kind of risk on a kind of destabilization as well. That was kind of the regulatory focus. This changed until 2017 with the ERC-20s, and the regulatory focus shifted away from monetary threats and kind of instability that cryptocurrencies could cause to these securities laws threats. And the SEC got involved and wrote the Dow opinion in 2017 at kind of the height of this Ethereum ERC-20 crypto bubble. We saw a serious interest in protecting investors and worrying about that. And I think the SEC gets kind of shot down a lot, and I'm not a huge fan of these kind of regulations, but I think for the most part, they've mostly gone after frauds and serious kind of perpetrators in the system. Now, going into 2020, we're seeing a very different kind of picture. We're seeing those fissures really emerge. We're actually seeing the world become more fragmented. So on the one hand, we've seen what China and these kind of outsider countries have done. In 2014, Russia banned crypto. Now they're kind of open to it. China keeps doing this pivot. As we all know, they keep banning it and then unbanning it, and they say they might ban it, and then they will. We even have other countries that are not in this kind of insider group, like South Korea that did a similar thing. India's banned it, but now they're saying they might unban it. And I think the real inflection point was Libra, because Libra it demonstrated that not only is this a threat, it's a threat that's going to happen soon, And it's a threat that might come from publicly traded, large US-based financial or corporate entities that are publicly traded. These governments are somewhat ineffectual. Europe, United States, and even to some extent India have said they don't want Libra there. It forced China's hand. China is now sort of expediting their own kind of blockchain fiat currency. And so we're actually starting to see a real currency war with independent, non-governmental third parties starting to play a role. And I think cryptocurrencies are going to be increasingly playing a role in this system. So our firm you can find us on the web at www.crypto.law. We do a lot of work advising different countries. We've kind of been following this space from very early on. You can email me at Zachary@Kelman.law. Our focus is we do litigation, we do anti-money laundering, we do international corporate structuring. We keep very close touch with the different countries and the laws that are happening in all of them. If you are a crypto business and you're looking if you have some litigation you might have to do, if you have some sort of legal issues that involve crypto, it is true that it's a very steep learning curve for people, especially for attorneys who are often, the better attorneys tend to be a bit older. It's harder for them to kind of grasp crypto. We've been in this space. We've kind of grown with the space. We understand it. We're based in New York City, but if you need legal advice of any sort, we're happy to answer a phone call. We do free consultations. Again, that's www.crypto.law. My name's Zachary Kelman. Email Zachary@Kelman.law. Thank you.